Good morning, everyone. This is Martha Stokes, CMT. I know a lot of you are following me and want to talk about flash crashes. For the indexes, they are rare, but for stocks during earnings season, they are quite common. They are an error often by HFT's AI that causes a stock to gap down. Gap ups, of course, everyone is hoping for. And so when a gap up occurs on earnings news, it's usually a good sign. If the market is moving up, everybody's happy. But if it suddenly gaps down or runs down, then we have a potential for panic selling or concerns. This morning around 3 a.m., which is when I get up and study the charts, we had a huge potential for a gap down at market open because was a void of buyers, and there was also a lot of international activity that was going on that was very negative. Almost all of the entire world was selling down, and the Dow and the S&P 500 and the NASDAQ did gap down at market open. It is a small gap on the daily chart, but when you look at it on the 1-minute scale, it's a pretty significant gap down. This occurred because HFT AI evaluated the situation. There was a void of buyers because Friday was kind of a down day also. And so there was a void of buyers because people were not buying because of the panic or the concerns that the stock market was going to crash. This is called a flash crash. A flash crash, again, as I will repeat, is uncommon on indexes, but is very common during earnings season. So you want to learn from this chart, even though this is the Dow. This was a big gap down at market open, and it is staying down. There's a few companies that are probably doing buybacks that are pushing it up a little bit, and there's a couple of nudges going on here. ETFs may be selling down as well because a lot of people try to sell their ETFs if they think that there's going to be a major collapse and correction. It was based on news, which was about Greenland and tariffs. And so this is still trying to come down. It's still trending down from where it was. It moved up, but it wasn't able to hold those gains. And so it's a trend that's slowly trending down at this time. That can change during the day. We have a long day ahead of us, but I did want to show you that intraday chart that is quite moving slowly downward. We have support right here, and this would hold it within the trading range that the stock has been, not trading range, but sideways trend, and this would be very good to have. So this would mean that there is activity going on to support the Dow Industrial Average components, or the selling ETFs that require the trust accounts to lower their inventory as well. If there's a huge amount of ETFs being sold, then the trust account for that ETF has to sell shares of stock so that it matches the index upon which it is made and designed to follow. So you will always have your ETFs closely aligned with the index upon which they are made. And if it goes up, then they add more shares of stock to the trust. And if it goes down, they lower more shares to the trust. And that is why the indexes and their ETFs follow very closely. There is a minor risk of a flash crash. It is a worrisome situation. A lot of people are afraid. This is a non-event. It has not occurred yet. It is merely the risk of an event, of something occurring around this concern that there is going to be more conflict and global conflict that could lead to other things. So as a non-event, the average investor or retail trader does fear and cause them to stop buying stocks or trading stocks. This causes a void of buyers. A void of buyers has a potential to turn into a flash crash if the next day or the following day they start selling, because now the fear has escalated on the non-event because nothing has happened yet. There's just the threat here and the threat there, or the concern here, concern there that's going on. So you need to be aware that it is a non-event, and that's what most flash crashes occur with. It's something that may happen or people fear will happen, but has not yet happened. Thus, it's a non-event. If it was going to be something catastrophic, like all the banks are going bankrupt like in 2008, or oh, there's a war that we're starting, or a war somewhere else, or uh, the US being attacked by terrorism, sort of thing, that will cause a bear market. But a flash crash is just a momentary period of time within a few days. We have a flash crash we can study in the past. This was in February through March and into March, and we started to see a downtrend occurring here because people were worried and nervous because things were changing. We had some tariffs that were being said they were going to be put into place, and we were worried about that. So all of a sudden in April, there's a void of buyers and there's a minor gap down here. And then the next day, there's another gap down because it continues a void of buyers. And then all of a sudden, here comes the flash crash. Everyone is trying to stampede out of stocks because they think that there's going to be this market crash. But however, the buy side institutions recognize this and they are pushing the price up the next day, and it ends with a neutral based long indecision day candle. The next day, more sellers come in trying to sell their ETFs. They're trying to get out of their ETFs because they fear that the market is going to crash. It went down so fast with big gaps and it terrified people. So the first day is surprise and no buyers. The next day, there's another surprise. Sellers start selling rapidly. Then we have dark pools pushing in to support the market, which they do during flash crashes because the fundamentals are now um, way below price and they want to push them back up into the fundamental levels. The next day, the buy side institution gets very serious and they push the stock right back up to a low below the fundamentals. And then there's a little bit of buying and selling as more sellers sell. Selling on the bounce is what that is. And then it resumes its uptrend and moves up. This is a flash crash. It may take about a month or so to recover, but then it resumes the uptrend. This is totally different than a bear market that would last 1.2 to 1.3 years on average. A bull market can last anywhere from 10 to 15 or even possibly longer, depending on how many new technologies are emerging at that time and coming to market and causing an excitement and more buying and buying. We're in a bull market in a tense, stressed situation right now with the indexes moving down on a minor gap that may reverse the next day or may have another gap down and more selling if the retail side panics. It's all about the retail side. The buy side professionals know what the fundamentals are for the company. They've been studying them and investigating well before, usually 2 months before the end of that earnings quarter. They're already adjusting their portfolios and already know what the earnings reports are going to be. The earnings reports the CEO have made expressed, most of them, that they feel it's a strong fourth quarter. How their guidance for the next quarter is another issue that will be evolved, also that the buy side is evaluating right now. So we have advanced buy side information that retail side does not have, but it's supposed to be good. If we really have a panic selling, it could rest here where you see the support here, lower support levels here. So that would be about the extent of the flash crash, going down to about here, somewhere in here. But that's no guarantee. We're not saying that it's going to happen. What I'm trying to teach you is what a flash crash looks like before it happens. It probably will be fine, but if it continues selling, then we can see that it may go on and then stop early. A flash crash is not a bear market. A flash crash is a momentary fear of a non event. The event has not occurred yet, but people fear that it will occur. So they sell ETFs or they sell stocks, which causes the indexes to go down in a rapid descent. So that's my topic for the day. I'll keep an eye on it, and I may pop in later in this week and give you more update on this flash risk. It is only a risk. It is not. So you should continue to trade, but be mindful that stocks can have huge flash crashes if their earnings are interpreted by the HFT AI as being down. Thank you for joining me today. Have a good trading day.